Hello everyone, welcome to the F5 class. I'm Mubarak Ali and I will be your tutor. Hello and welcome everyone to our F5 class. I'm Mubarak Ali and an ACCA member. I will be your tutor for the F5 session. So welcome everyone again. How are you people? Can you guys hear me? All right, I hope everybody's fine and well. Right, so we have Khushal, Nishika. I'm sorry if I pronounced the names badly, okay, because it's difficult with international classes. All right, Fahima. Okay, so we will be studying for F5 in this session, and I hope we'll have a good time. This is a challenging paper. You may have heard stories and legends regarding it, that it's difficult and doesn't, passing it is difficult, and it is a challenge. Well, passing it's not difficult. It's just that we, as in a fight, you said that you have to give respect to your opponent. That's the whole situation. You need to understand what the mechanics are. It's like a boxing ring. You need to understand what your opponent is going to, do. And if you know the moves, similarly here, if you know the moves of the examiner, and you know the tricks and tips of the syllabus and how to deal with it, I think it's not a difficult paper at all. And the only reason is there are a few shortcomings that students have. So we don't work on that and we take things lightly. One of the major problem that students have with this paper is they try to pick areas which are main areas, only study that and leave the rest. They just try to study it only for the purpose of the exam. Being an expert in being involved in teaching for the last 14-15 years it's been now, I can tell you I have looked at lots of international syllabuses of different qualifications around the world, and believe me, the management accounting of the ACCA, particularly this F5 paper, it is by no means lesser than any other advanced paper in any other qualification in the world, not only in ACCA. I haven't seen this much depth and this much knowledge in any management accounting paper as we have it in F5. So that's something that we have to give respect, and definitely I then don't need to tell you how much time and how much dedication we need for it. If I am telling you that it is one of the most in-depth and knowledgeable syllabus of the management accounting in any qualification, I am not stepping back one bit from my statement. So it's not difficult. I'm not saying it's difficult. I'm saying it's in depth. It has a lot of knowledge. It needs tactics in the exam to get through it. So during this course, we'll be learning that, and hopefully we will come out successful in that. So if you be with me and, work with all the techniques and things that I tell you, hopefully there is nothing difficult. In fact, we are going to learn good. All right. How many people we have? 4 people. So did you guys study F2, all of you? I just want to evaluate where we stand, right? So as we say, we analyze the current position. After that, we make plans for the future. So I would like to know from you people, like, do you have you studied, or is anyone with exemptions? Right? Fahima, Vishal, Nishika, Sonam, anyone, please? And you have to talk to me because I'm looking at the camera and there's only one person in this room, and that's me. And all of you guys are in that thing. So it's better that you talk to me. You can talk to me here in this chat box, right? I studied F2, okay. Got exemptions. So only Khushal, you have exemptions. The rest of everybody has studied, right? Is that fine? If I get that idea. All right, somehow other people are probably not. All right, so Nishika has exemptions too. All right. Okay, so Fahima, Hushal, Nishika, and who else is with us? Sonam, can you please tell me? Sonam, I'm waiting. Have you got exemptions too? She's probably maybe not hearing. Anyway, the point of asking is not that it's something, but all right. So half of you have studied and half. All right, no problem. Okay, so since we are half people having exemptions as well, so what we are going to do is keep it basic, okay? And we are going to assume that, I'm not going to assume you have studied a lot of things. I'm just trying to evaluate for myself how we are going to go about it. Okay. One of the thing that I want to clear for all of you, whether you have got exemptions or whether half of you have studied, there is one major issue, okay, that you have to understand. And that's one of the major reason of students being unsuccessful with this paper. And that reason is that this paper, I consider it essentially a P series paper. It has 2 case studies. 2 case studies where you have to write essay-based question. We're going to introduce the paper in a while. There are 3 case study scenarios in which there will be MCQs, and 15 MCQs are without scenarios. They're small MCQs. There will be scenarios, but there will be short scenarios. 3 MTQs question are bigger question. They will have bigger scenarios, and 2 essay-based questions are definitely having bigger scenarios. So you're actually dealing with effectively 5 bigger case study questions. Okay. Now the problem is the students before that haven't dealt with something like that before, whether it's in F2 or in F2 there are MTQs, but still it's not at the level of F5. So one of the major reasons students fail is the gap between the F2 and the F5. The gap between the F2 and the other qualification and F5 is huge. It's literally huge, and you have to appreciate that. It's not something to be afraid of. It's something to be evaluated, so that in order to cover that gap, okay? It's not that I'm saying that you need to be afraid of. We need to understand the gap. We need to understand what gap, how much we have to study to fill that, and what tools and techniques we need to fill that gap. And that gap is huge. In F2 and earlier foundation level courses, for people even who got exemptions, we just learn techniques and tools and what is the variance, what is that, what is the difference between that, what is the cost per unit, what is the absorption profit, what is the margin. So it's the calculation, what is what, true, false, it's that kind of thing. In F5, there is no true, false, there is straightforward, analyze the business performance and make comments, okay? So that is what basically kills people. That's people's exam. right? And that's what actually disturbed the exams. So during this course, we're going to learn how to deal with those case study scenarios. But you have to understand that we have to fill a bigger gap, okay? And you have to be mentally ready for that. All right. So that's it for the slight introduction and a slight like caution flag. Okay. Otherwise, it's not difficult. There's no difficulty. So let's start introducing the subject straight away. All right. F5 is basically a management accounting paper. What is management accounting? Management accounting is all about planning, decision making, and control in your earlier syllabus. For those people who have got exemptions, I will encourage you to study some topics from your F2 book. I will tell you from time to time. Okay, it's not needed right now, but when later on in the subject there are some things that I'm going to tell you, it's better to have. And it's not a like huge reading. It's probably 10 pages maybe, or something, a 1 day or 2-3 days worth of reading. So if you do that and it can get your basics right, so what harm is in it? Okay, so it's management accounting, it's planning, decision making, and control. It's how business plans are made, decisions are taken, and how control is applied so that the business performance can be managed. This is why it is called performance management. How to manage the business performance. There are three key areas of management accounting: planning, decision making, and control. Right? So first of all, if we get things correct and in the right direction, you need to learn that your people who have the F2 knowledge will know what I'm talking about. The other people, you should get along with it. So management accounting is the subject, and it's planning, decision making, and control. Planning is the process of setting future targets. Decision making is daily decisions that managers take. For example, a loss-making product, should we close it or not? An investment, should we make it or not? There is a product A and B option, which one to launch first? There is limited labor available. We have few products. Which product we should allocate the labor to? We have limited finances available. Which product we should make? How much sales we should make? Should we increase the sales, decrease the sales? These are decisions that the manager daily needs to take. And in management accounting, we are going to learn how managers should be taking these decisions. Okay, and we'll help them to take these decisions, so timely and effective decisions. So these are basically the syllabus areas, A, B, C, D of the F5 syllabus. What we are going to be doing is learning these. This is the syllabus areas. We are going to start with this. Let me first check my pen and everything. Okay, so this is your whole syllabus of F5. Okay. Now, the first is information technologies and data analytics. This is mostly theoretical and too much theory, and it's really not really related to what the F5 syllabus is related. Why not? But it's not that much related. So I've kept it for the end of the lectures. So we will study them in the last lecture. The rest of everything will be in order. So we are going to start with section B, which is cost accounting techniques. Okay. Then we're going to be studying section C, which is decision making, then budgeting and control. And at the end, we're going to be studying performance measurement. If I give you an overview of the syllabus in detail, what it includes is syllabus area A is basically the data and information and data analytics. I'm going to leave that for the end. So we'll start with section B. which is basically advanced cost and management accounting techniques. In which first we are going to study traditional absorption and marginal costing. Which is techniques to calculate the cost of a product. Then we are going to study activity-based costing. Then target costing. These are basically techniques, life cycle costing, and throughput accounting. These are the techniques that we are going to learn in the costing chapter. Okay, so we are going to start with them one by one. This will be our sequence. Then we are going to move on to decision making, which is section C. In decision making, we are going to be learning a whole lot of decisions that the business manager needs to take. So we are going to be studying CVP analysis, decision making, which is basically decisions related to production and sales volume. And we are going to be learning linear programming and limiting factor decisions. If a business has restricted resources and more production, what should be done? Then pricing decisions and other short-term decisions, product launch, product close, right? Restricted resources, make or buy decisions, and then decision making with risk and uncertainty and probabilities with it. Right? Section G is budgeting and standard costing. It's basically budgeting and variances. Right? There are quite a lot of detail in it, how budgets are prepared, what type of budgets are there, quantitative methods in budgeting, and then how control is exercised in terms of standard cost, which is basically comparison of actual results with the plans. We're going to study that in its own appropriate time. And the end is performance measurement. All right. Using ratios and other techniques to analyze the business performance and come up with conclusions whether a business is performing good or bad. Right? Is the performance good or bad? So we're going to be learning about that. Okay. This is what the whole syllabus is. Let's deal with and study about where F5 will be connected. F5 is coming from your F2, right? We're trying to learn what we are studying is what, okay? What's the status of it? So it's coming from F2. This is where we are, okay? This is your F5, and it leads to two things: the SBL and the Advanced Performance Management. These two subjects will have knowledge that will be learned during the course of this session in F5. And it will definitely give you skills through which you can study, pass your SBL, which is Strategic Business Leader, and Advanced Performance Management. All right. So it will hit two other subjects, and it's crucial for them. So the basics here is really important. All right, and what about the paper? The paper has three sections: Section A, Section B, Section C. It's a 3-hour paper, right? Section A, we have 15 MCQs, or 2 marks each, right? And these are normal short questions with short scenarios. Some can be even true, false in it, box questions, right? So this will be spread across the whole syllabus. The objective part will be, the OTs will be spread across the whole syllabus. Okay, now there are a few technical things that I'm going to tell you about the paper and how the syllabus is examined. So let me come here. The section A will basically cover the whole syllabus, obviously. So the 15 MCQs will spread across the whole syllabus. It will include questions from the performance measurement, the costing, every part. We cannot spot it. We tried, but we couldn't, because every paper have a mixed question, two questions from one, two, three questions from another chapter, from another. So every chapter will have two, three questions. So around that, like 15, 5, 10 chapters, and easily can be like 15 questions, one or two questions from each. We make it 15 questions. So this is spread across the whole syllabus. We cannot spot, and we cannot say that from this particular area you will get like 5 or 6 or 4 MCQs. No, can't do that. So this will be spread across the whole syllabus, right? This is section A. The section B, which is 3 compulsory scenario-based MTQs. What is a scenario-based MTQ? There will be a case study. You will have a case study. So you'll be given a whole scenario. And then there will be 5 tasks. 5 tasks means 5 questions. Question number 1, question number 2, number 3, number 4, number 5. Okay, so it may, and everyone will be having 2 marks. So what you're going to do is, there is a scenario, and on that scenario there are tasks which are 1, 2, 3, 4, 5, and each one will have 2 marks. So each one will have 10 marks. So scenario number 1, scenario number 2, number 3, there will be 3 scenarios. Okay. Now, it has been observed that these scenarios, I can tell you this, that these scenarios are often including these ABC areas. It hardly include this area. It doesn't. It hardly include this area. Okay. Mostly, it may have question from these two. It's not. I'm not saying that it doesn't include this one, but mostly it will hit these 2 areas. The 3 questions with 1 question from here. This one is very rare to come appear in section B. Okay. And this brings us to section C, which is 2 questions, big scenarios worth 20 marks each, and in which you have to write using Excel or Microsoft Word. So they are essay-based or writing questions, comments-based question, and it's 40 marks. So it's 40% of your paper. So this is quite a bit of a challenge, and definitely you should be preparing for it. We will be preparing for it. Okay. Okay. So where does this going to head? Now, as I said, that this section so far is not in A, it's not in B. So where will this appear? It's going to definitely appear in section C. 1 question from this area in section C is confirmed. So performance measurement, 1 question, 20 marks. The other one may appear from here or somewhere from here. Number 2 question. It will appear from D section or C, rare hoga. C will be rare, okay? But it may appear from D. So these 2 are the 1 is confirmed from section E. Okay, so these are actually the areas of the exams and syllabus linkage. Now, this is our own experience, and this is by far so been correct, and some guidance has been provided by ACCA. For example, this guidance that section E will not be tested in the section B question, right? This one, the MTQs. This will not include performance measurement question. This guidance is provided from ACCA, so we can count on it. Okay. And the costing section will not be tested. The costing section will not be tested in the 20 mark section C. So this section C will not include the costing portion. All right. So this is also guidance provided by ACCA. So in section C, we should be looking at, this is B section, this is A section. So A is across the whole syllabus, B is across like 3 sections, and section C of the paper is areas of budgeting and performance measurement, or maybe decision making, but it will not include costing. This one will not be in section C, right? So this is what the guidance of the paper is. Are you guys here? Are you guys with me? Can you guys hear me? Okay, you will have to talk to me a lot, okay? So to keep my interest alive as well, okay? In physical class, it's a lot easier because you can just ask people, you can interact with them. So your interaction is really important for me. Okay, that's great. Okay. I have to keep you alive, and you have to keep me alive as well. Because teachers can, get boring as well. So you have to keep me away from being boring. Okay. All right. This subject is not something which will let us bore, and make our time bad. So it's really interesting. The first class or so may be slightly boring because there is too much costing included in it, and you may get a feeling that this is what kind of subject this is, but it's only probably will be up to this class. The next classes will be when we go to decision making and performance measurement. Really interesting, one of the most interesting and exciting subject, probably in my opinion. F9, F5, one of the most exciting subjects. In F9, the whole course is regarding stock markets, share prices, investments. Here, it's decision making, performance measurement, how the business is operating, what data we have to analyze to see how the business is operating. It's a diagnostic process, control what is going wrong, how to fix it, what are the reasons. So there is really interesting stuff coming later on. All right, what are the skills the students need? The students need to be able to understand the concepts, obviously, but not only understand the concepts and do the computations, but in addition to that, there is a need to understand the scenario with being able to write comments. This is what I was talking to you at the start of my talk. This is where, students, it becomes a problem for them. They understand everything. They understand a particular model or a particular concept or a particular mathematical model. A case study appears with the same model, what to do with, where to get figures from. Where is what figure? So a plus b whole square, and there is no a, there is no b. You have to find it out in the data. So that's where, so it's a person knows about car and everything, but you just give him keys and tell him, okay, this is the road, this is the car, start driving. I don't think so. I don't think so. It's that easy, right? It's not just reading a driving manual and you can do things. No, that's where the problem starts. So it's not only sufficient to understand the concepts, but also how to deal with scenarios. So my plan will be, in fact, our plan will be to deal with as much scenario-based questions as possible. The MCQs are also important, obviously, there is no doubt about it. But since you're going to deal with 5 scenarios, 3 will be the MTQs, the short questions, and 2 will be the long questions, the 20 marks. So we'll be dealing with 5 case studies, right? So our plan will be to do as much case studies as possible. Okay? Does that sound good? Sounds fair to me. Okay, guys, so let us start. Okay, and our first, these notes will be provided to you, so no worries about it. Okay, Okay, let's start. This will be the volume one. These notes are in 4 volumes. Okay, these are very detailed. Even if you don't take the book, it's okay. We have included enough practice questions. These are the notes. Every notes will have a volume 1 notes, volume 2 notes, 3, and volume 4. So we have 4 volume notes, and we have 4 volume of question bank. Each volume has a notes and a separate question bank that will be provided to you. All right. Okay. So the first one is introduction to the paper, and chapter number 1 that we're going to start with is absorption and marginal costing. Okay. So let us start. Before moving on, you guys want to ask anything, share anything? Please. That's good. All right. Before moving on to the costing systems and things, let me just in for 5 minutes or 7 minutes, okay, let's introduce what management accounting is as a subject, just for the sake of the 2 people with us. And the other 2 who have already been through F2 can guide us as well with their insights, right? Right. Management accounting is a subject. The purpose of it, I'm going to be very specific because I don't want to give too much time to it because it's really F2 stuff, but I'm going to revise it for you guys. The purpose of management accounting. F5 is management accounting or performance management. The purpose, management accounting. Someone asks you, what do you study? Management accounting. What do we do in it? Sometimes we are become speechless. One time my dad asked me, I was studying economics, and he said that, kid, define economics. And I was like, economics doesn't have one definition. So I was like a bit stuck. And he said, you don't know the definition? And I was like, what happened to me? All right. So the purpose is 3, okay? Planning, decision making, and control. All right, planning is what? Business planning. We do what? We plan for the future. Can in the today's business environment, can you imagine any company, the bigger names, not a small company, Samsung, Apple, and the car manufacturers and other laptop or computer manufacturers? Can you imagine anyone operating without a plan, without having anything for the future? Cannot even imagine that because that's not how things are done these days. So we need to plan. What is planning? In planning, we do 2 things, right? In planning, we do 2 things. We set future targets, which are called objectives for the future. And then we also decide. So set is what to achieve and how to achieve it. Okay. I'm going to link everything and bring it here to the marginal and absorption thing. Okay. So we decide, we set targets. We set targets for business. For business, but for what? We set target for sales. How much sales we want to make in the next year. How much production we will need to do in the next year. How much profits we need in the next year or we want to do in the next year. How much number of people we have, how much number of labor hours we need to work, how much material we need. This is what future targets are. So we need to work out what in the future things are going to be or expectations. So we, according to based on those expectations, we set our targets. Right? Decision making is routine decisions, which are simply choices that the business make or choices between alternatives. Right? Managers needs to plan, needs to decide which products to sell, which product to launch, which one to make. A loss maker product, should we close it? Which investment to make? These are all options, decisions that they take on daily basis, as I said in the start. So manager needs to take timely and effective decisions. For that, management accounting helps managers to do that, right? So we actually need to take timely and effective decisions. Control. Control is the process of keeping check over activities, but in management accounting, control is exercised in different manner. Control is once a plan is implemented, once plans are implemented, we are interested to see whether those plans have actually worked or not, whether performance is according to the plan or not, whether our expectations are there or not. What we were expecting, did we achieve it? What we planned, did we really achieve it? And how do we do it? How will we know what we have planned? Have we achieved it? We take the actual results and compare the plans with the actual results. So control in management accounting is basically the comparison of actual results with the plan. Between plan and actual results to see what has gone wrong. Have we achieved it? For example, a manager might have decided to sell 1,000 units for the next month. Actual results are collected and they came to know that we only sold 800 units. We couldn't sell 1,000 units. So it means they fell short of their target, right? Okay. So is this good or bad? This was not good because the target was 1,000. We couldn't do that. Is that it? Will that finish the control process? The answer is no. Control process is a whole process. So what will be included in the whole control process? We compare actual results with the plan. This is what we do. Compare actual results with the plans or the targets. We do what? To calculate the differences, the difference between the actual result and the plan. These differences are technically called variances. To calculate variances, right? What has gone wrong? If the variance is good, like it could be 1,200 units, so that's good, that's fine, that's good. So that's not a problem. So we identify the variances which are a problem, right? Is that it? Answer is no. Second is analysis of those variances. Analysis and investigation of those variances. Is that it? No. After analysis, why do we do this analysis? To identify the reasons why that variance occurred. If something is not achieved, why it was not achieved? What was the reason? Okay. Were we short of finance? Were we short of vehicles? Were we short of staff? What happened? We didn't get enough time. We set a wrong deadline. What happened? Something went wrong. Whatever it was, identify that. So identify the reasons why. And then the third is the control action taken. Okay, that is the essence. The last one, the control action, is the essence, the heart of the control process. If everything is done, imagine often happens in a political environment, things are analyzed, and corruption is analyzed, and reasons are identified, people are identified, often it happens, reasons, everything is worked out. Then do they work on it? Do they actually take steps to correct things? The answer is no. So what happens? That problem stays at its place. So all of the effort, the analysis, everything was just a waste of time and money. The essence of control, the soul and heart of the control process is the control action that needs to be taken in order to correct things, right? So this is what control works. So management accounting is planning, decision making, and control. Okay. Now, let's link it with what? With costing. Costing or cost accounting is an area, or you can say a subsection or area of management accounting. In what we do in cost accounting. In cost accounting, we collect and gather and record all the costs of the business or cost of the product. Why? In order to calculate the cost of the product. To calculate the cost per unit. Okay, so cost account, this is really basic, like F2, right? So we need to calculate the cost of a product in order to know what the cost per unit is. Why do we need to know the cost per unit? We need to know the cost per unit in order to establish a sale price, right? If we don't know the cost, what will be the sale price? To know the profit, simple. Okay, to control the cost, if we know how much cost we are incurring, only then we are going to be able to control it. If we don't know what the cost is and how much cost we have incurred, how will we control it? Okay, now I have said in my talk that the cost accounting is part of the management accounting, right? Okay. Why is it a part of the management accounting and why is it so important? Now, in management accounting, we have studied, I'm just linking it, all right, for your information and trying to simplify it. Okay. Now, in the start, I told you that management accounting takes decision. For example, let's take a decision that there is a loss-making product, okay? And the company wants, or the manager wants to close that product because it's loss-making. Loss-making is what? When the cost is greater and the sales are less, right? So its sales are not sufficient to cover the cost, making a loss. The manager wants to decide to close it. So it's a decision. That's a management accounting process of taking a decision whether to close a loss-making product. That's fine. Okay. How do we know it's making a loss? Because we have calculated it. So there is a product, a hypothetical product. Let's assume a product X. It has a sales of 1,000 while it has cost, total cost of $1,200, say per unit, you can say. So the cost at 1,200, while we are selling it only for 1,000 because nobody is willing to buy it on 1,200. So this is 200 loss that we are incurring on it. All right, that's fine. Should we close it? Probably yes or no. That's a decision that the manager is facing. That's what we do in management accounting. What I'm trying to tell you that the cost of the product is 1,200. How do we know it? How did we know the cost of a product is it's making a loss? Why? Because the cost is 1,200. How did we know it? Because this cost has been recorded somewhere. It's been collected somewhere. And where we do it? We do it in the cost accounting section. We calculate the cost of a product in the cost accounting section. All right. So the cost accounting, basically, you can say, is the source of the cost information. For management accounting, planning, and decision making, we need a lot of cost information. We need to know what the material cost is, what the labor cost is. We need a lot of cost information in order to take valuable decisions. If we don't know the costing information, we cannot take bigger decisions. We cannot even decide what the profit will be, because the profit is the difference between the sales and the cost. If we don't know the cost, believe me, it will be hard to take any management accounting decision. All right. And where the cost come from? Cost accounting section. So they are also responsible for establishing the cost of a product. Okay. Is it fine? Okay. So in cost accounting, we're establishing the cost of the product. What is the cost of a product? I'm taking it from the basic just so that to bring you to that level of costing which is really needed for the management accounting. If someone has studied it or have not studied it, doesn't matter. I just still need to want to provide it so that you people have a knowledge of what we are actually doing. And this costing section has around 5-6 chapters, so I don't want that there is something that you don't know it, right? So when a company makes a product, what type of costs are incurred? Now we already established that we need to know the costs, right? We need to know the cost of the product. Why? Because to take decisions about sale price profitability. So when a company makes a product, which type of costs are incurred? When a company makes a product, 3 costs are incurred normally: material, labor, and expenses. This is a huge discussion. I'm going to be slightly shorter on this because it's way below the level of F5, and I'm explaining it just to have a revision with you, all right? And maybe some people don't know it, right? When a company makes a product, 3 costs are incurred: material, labor, expenses. Let's take the example. Let's take an example of a car, or let's say furniture company making chair and tables. So when they are making chairs and tables, they need what? Raw material, that is wood, fabric, right? Cloth. They need labor because someone has to fix that labor, right? Do painting or something on it. And expenses, which is electricity, the machinery work, or polishing expenses maybe, all right? So 3 costs are incurred. These costs can be direct costs and these costs can be indirect. So these costs can be direct cost. Direct costs are those costs which can be identifiable with 1 unit of a product. So it means we can have direct material, direct labor, and direct expenses. Together, they are all called prime cost. And we can have indirect costs. Indirect costs are those costs which are not known or not identifiable with 1 unit of a product. Okay. So when a company makes a product, 3 costs are incurred: material, labor, expenses. These 3 costs can be direct costs: direct material, direct labor, direct expenses. These 3 costs can be indirect costs. We can have indirect material, indirect labor, right? The direct costs are called prime costs. The indirect costs together, they are called production overheads. All right? The indirect costs are what? They're called production overheads. Okay? So the prime costs plus the production overheads, which are these 3, will get us what? Will get us product costs per unit. Okay. So the cost of a product includes these costs: material, labor, expenses, which are direct material, direct labor, direct expenses are prime cost. Known per unit means that about which we can tell that in this unit, $10 of wood will be needed direct. For this chair, one labor is needed, which will be working on it 2 hours, and he is paid, say, $6 per hour. So 2 hours at the rate of $6 per hour will be $12 for one chair. This is direct labor. There is an expense of polishing electricity or some expense, right? Say $1, that is direct. Indirect costs are all those costs about which we cannot say that how much will be the cost per unit. For example, there is a production supervisor who is not making the chairs. I'm giving the example of a furniture manufacturer who is not making the chairs and tables. He's just supervising the production, and he's taking salary. He's taking a salary of, say, $2,000. Can we say that supervisor salary $2,000 per unit will be what? Just imagine. Answer is no. We can divide it. If you tell me that, sir, we can divide it, yes, but will that be a real cost? Answer is no. $2,000 in 1 month, they are making 1,000 chairs. So the cost of supervisor will be $2. In another month, they may be making 500 chairs. In another month, they may be making 100 chairs. So if we start dividing it, every time the cost per unit will be different, and we can't afford that. The cost per unit has to remain the same in order for the sale price to remain the same. Okay, so indirect costs are all those costs. Indirect cost material example will be any material which is not known per unit. For example, in the furniture, there is nails and glue, and these type of things are used. The nails, they are basically used in the chairs, and we don't know because it is used from a box. We don't know what the cost of 4 or 5 nails. Indirect labor, I have already gave you the example of like a supervisor. Indirect expenses like electricity. Can we say how much electricity is used in each like chair or like a pen? The bigger the product, we can associate expense. For example, we can say how much electricity is used when a house is constructed, or when an aeroplane is made, because that takes a project. It takes like 4, 5, 6 months. But the smaller the product is, like ballpoint or pen or a small chair or something, it's hard to say how much electricity is used in each product. So that will be an indirect expense. Okay. So the cost of a product includes direct cost, which is prime cost, plus the production overheads, which is the indirect cost. Okay. And we get the cost per unit. Was that fine? Is that fine till now? Are you guys with me? Anything you want to ask? I will move on if we are good till now. So please tell me. Other people? Can you people hear me? You have to respond to me in order to for me to be relaxed that what I'm saying makes sense to you and you're getting it. All right, that's good. That's interesting. In fact, that's encouraging. I would rather say that's great. That's great. Okay. All right. Now we are getting into the problem zone. Okay. Not a problem zone, a challenge zone, I would rather say. Okay. Okay. Now, when we are calculating the cost of a product, we have already established one thing, that some costs are direct costs. Direct costs are those which are known per unit. Some costs are indirect, which are not known per unit, about which we can't say how much is the cost of one unit. So the cost which are known per unit, and bear in mind, we want to establish the cost of one unit. And why do we need to do that? If we have this, only then we can have the price, right? So we need to establish the cost per unit because we need a lot of decisions regarding that. Okay. So the cost of one unit. So the cost of a product includes direct and indirect. The direct costs are not a problem because we already know them per unit. For example, material $10, labor is $20, direct expenses 4. So the prime cost is 24, which is the prime or direct cost. Prime cost is all direct costs. Okay, the problem is here. What we have learned about these costs, that we don't know them per unit. All right, that's it. A product has a lot of costs which are not known per. They are there in total, like supervisor salary is given in total 2,000, rental is paid, electricity bill is paid, gas and heating and other charges, utility bills are paid. So we know them in total, at how much total electricity, how much total rent, but we don't want it in total. We want it in per unit. Now, again, if you tell me that, sir, why don't we divide it? Yes, we can, but will that be a reasonable and accurate estimate? Answer is no, because one time the units will be different, the other month the units will be different. So one month we will sell the product at one price and like $100, and the next month we'll be selling it at $50. Why? Because now we have more units and now we have less cost per unit. Now we can't do that, because if the business is selling a chair on $100 at in one month, and for $50 in the other month, and for $200 in the third month, nobody's going to be sure about what this company wants to do. So the cost per unit has to be constant in order for the sale price to be reasonable and constant. So we can't divide it. So okay, so we want to calculate the cost per unit. We already know the prime cost. These costs, we know them in total, we don't know them per unit. So how do we make them per unit? Okay, how do we make them per unit? Now, this is where these two concepts comes into play: absorption costing and marginal costing. The word costing means the calculation of the cost of a product. Word costing means the calculation of the cost. Okay, and now we have two costing methods. Why two costing methods? Let me tell you that. Now, this is important, and I want everybody to focus here, okay? These production overheads, indirect material labor, are of two types. One is called variable production overheads, and one is called the fixed production overheads. For production overheads, I will use the terminology POH. All right. The material, labor, and expenses, they all have two types. Either they are variable or fixed. What is variable and fixed? Variable costs are those costs which are increasing and decreasing with the activity. If activity increases, those costs are, these variable overheads are here as well. Variable costs. The material cost is also a variable cost. Okay, variable cost is cost behavior basically. Variable cost is any cost that increases with activity increases and decreases when activity decreases. Fixed cost is that cost which remains fixed regardless of the activity. First, you need to understand this cost behavior. And these fixed and variable are in the direct cost as well, and these are in the overheads as well. A variable cost is that cost which increases. These are units. If units are higher, this cost is higher. If units are lesser, like for example, 1 unit cost $5, 2 unit cost $10, 3 unit cost $15, 4 unit cost $20, and so on. This is a variable cost. So if the cost Speed is greater, the cost is greater. If activity is lower, the cost is lower. So it increases and decreases with activity. The next cost is fixed cost. Any cost. Fixed cost is that cost which remains fixed regardless of the activity. It even incurs at zero activity. For example, there is a factory and the factory is taken on a rent. All right, they are being hired and it's being hired and it's taken on a rent, and the rent is say $5,000. If it is taken on rent, does it matter? And the agreement is made. The agreement is made, it's taken on rent, signed are done, and from January 1st, it's being on rent. There is no production in January. Will the rent be paid? Yes, because it's a fixed cost. So it will even incur on zero activity. They don't do any production, they will pay 5,000 fixed. If production is 100 units, how much is the rent? Will the rent increase? 5,000, 200, 300, 400, 500, whatever is the number of activity, they will pay the same rent. So any cost can be variable or fixed. Similarly, in production overheads, there are two types of overheads. One is variable, those overheads, indirect material, or labor or expenses, which are variable, which increases or decreases with the activity. The next is fixed overheads. Fixed overhead is that overhead which remains fixed. Both, I'll give the examples of overheads for both. Variable overhead is that indirect cost. You cannot call direct material as overhead. Why? Because it's a variable cost, but it's what? It's a prime cost. It's not an overhead. So what will be the example of overhead? Indirect cost, which is variable, right? And the best example is, for example, machine oils and lubricants. There is a machine which needs oil, lubricants. If production is more, there will be more lubricant oil used, or diesel or petrol, if it's a petrol or diesel based machine, right? And if there is zero production, there will be zero diesel. Imagine it's a diesel based machinery, not electric based. Now tell me, if there is a machine which is running on diesel, can we tell how much is the cost per share of the diesel? If it's used, for example, if it's used, it's an example. We can't say that, but we know. So it's an overhead, all right? It's not known per unit, but it's variable, okay? Fixed, example of fixed overhead. Fixed overhead is simply rent, supervisor salary, which I told you, okay? Now, I'm trying to bring you to marginal and absorption costing. And this is, as I said at the start, this is critical, right? We're trying to calculate the cost per unit. Let me repeat and bring you back to the whole framework. We're trying to calculate the cost per unit, all right? In cost per unit, we need direct costs and indirect costs, both in the production. Direct costs are easy because they are known per unit. Indirect costs are not known per unit. So what we are going to do with it, we are learning that. Indirect costs, which are production overheads, are of two types, variable and fixed. Okay, we're here. Now, variable costs are not known per unit, but with the passage of time and experience, okay? Please focus. With the passage of time and experience, they can estimate it with quite much accuracy what the cost per unit is. For example, I have a small generator in my home and it uses diesel, right? And first I didn't know how much diesel it consumes. Sometimes it used to take 1 liter, 2 liters. Then with the passage of time, I came to know that when there is more load, it has this consumption, which has, when it's low load situation, then it has this consumption, and average load situation, it has. Now I can fairly predict with quite much certainty, with a very small error, it's always there, that what the cost of diesel per hour is. So variable overhead is an indirect cost, but it can be estimated per unit, okay? It can be estimated per unit. So this problem is solved as well. So let's say the variable per unit cost is estimated to be $2. Variable overhead cost. Again, We're trying to calculate the cost per unit. So we're trying to calculate the cost per unit. We have direct costs now. We have variable overheads now because we can know that per unit. The problem is left with what? Fixed overhead per unit. What to do with it? Because these are costs which are not moved at all. Okay? They are even going to be incurred even if there is zero production. Is that fine? There is no production. That's with the variable overhead or any other variable cost. If the activity is zero, the cost will be zero. Okay, but with fixed overheads, even or any other fixed cost, and fixed overhead is a fixed cost, it will incur even at zero activity. So how are we going to include it in the cost per unit? Now here we have two costing methods. Okay, we have two costing methods: absorption costing and marginal costing. For what? For dealing with fixed overhead. So let me write it again because it's critical. So we are trying to calculate the cost per unit. And for cost per unit, we need direct costs, which are prime costs, which are direct material, direct labor, direct expenses. All right. And along with this, we can add production overheads, variable production overheads. Variable, because I have established for you guys that we also know this per unit. So this is 10, this is 20 from, this is 34. This is 4. So this is 34, and this is estimated to be $2 as well. Now the fixed cost or the fixed overheads is a fixed cost. For example, it has $10,000 cost. Now, how do we add $10,000? Because it's 10,000 zero activity. It's 10,000 at 100 units. It's 10,000. It's 10,000 at 1,000 units. It's 10,000 at 10,000 units. So how do we make it per unit? Now, to deal with this one thing, we have two costing systems: absorption costing and marginal costing. Now, absorption costing and marginal costing are basically two costing systems. Okay, absorption costing and marginal costing are two. Actually, these two costing systems emerged because they have different treatment for the fixed overheads. Absorption costing says that fixed production overheads should be added mean absorbed. That's why it's the name absorption costing. Added to the other product costs. It should be part of the product costs, be part of the manufacturing costs. Now here there is a distinction between manufacturing cost and other costs. Right? Company has a lot of other costs. One is like manufacturing cost, one is non-manufacturing cost. For example, distribution vehicles and IT and R&D, research and development. Should research and development cost be part of the manufacturing cost? What do you think? Should KFC add their research and development cost in their cost of their burger? No. So here we have to make a distinction between the production cost of a product, which is often called factory cost as well. You might have heard some people saying that I have bought this product on a factory.
All right, people, I think my internet restarted. Something happened. It's normally not usual like this. I don't know what happened. Is everybody here? Okay, something wrong happened. Okay, things like that happen all the time when they're online classes. So, is everybody here? Okay, so let's go back to where we were. Okay, we were with the two costing systems. So fixed overheads are not known per unit. So now we have two costing systems with it, absorption costing and marginal costing. Did you understand the concept of manufacturing cost? Manufacturing cost, the making cost, right? So absorption costing tells us that the making cost of a product, the production cost, will incur or involve all the prime cost, the variable overhead, plus the fixed production overheads. Although fixed, they are difficult how we are going to add it, but we have to add it. We need to find a way to add it. Marginal costing says that no, fixed overheads are fixed in nature. That's a fixed cost. So fixed production overheads should not be part of the manufacturing or production cost. So what we're going to do, it should be included in other costs. Treated in other costs. Other means R&D and non-production costs, other non-production costs. So now we have two different costing systems having two different methods to calculate the cost per unit. Okay? To calculate the cost per unit. Now, it means that if we are calculating the cost per unit using absorption costing system or using marginal costing system, there will be a difference of the cost per unit. In absorption costing system, if we are calculating the cost per unit of a product based on the absorption costing system, the cost per unit will be what? The cost per unit will include what cost? The cost per unit will include direct material, direct labor, direct expenses. This will be the prime cost. And with this, we add variable production overheads, and we also add the fixed production overheads. Okay, so the cost of a product will include all of these costs. This is why it's called a full costing system. Full costing means that whatever is incurred during the production, fixed or variable, is included in the cost of the product. While marginal costing takes a different approach to calculating the cost per unit of a product. Marginal costing tells us that the cost per unit should include direct material, direct labor, direct expenses, will be prime cost, And along with that, we add only one overhead, which is the variable overhead. Why? Because we can establish it per unit with the experience, as I said. Okay. There will be no fixed overheads in marginal costing. So it means that if the material cost is $10, labor is 20, this is 4, this is 2, and say this one is also estimated at $8 in absorption. How we are going to estimate it in absorption? We are going to include it. How and what amount, we're going to learn that in a while, but we have to include it in the manufacturing cost. So the production cost, the cost per, whenever I say cost per unit, I mean the manufacturing cost, not the total cost of the company. So the manufacturing cost is 10, 20, and 30, all right, 40 and 44. Okay. Yeah. While in marginal costing, the cost is 10 for material, direct labor is 20, direct expenses is 4, and variable overhead is 2. So if we calculate the cost of a product for the same product based on the marginal costing concept, there will be no fixed overheads included in the cost of the manufacturing of the product. So it will be what? It's 34 and 36. Okay, so there will always be a difference. Absorption costing will have a higher cost per unit. Now, you might be surprised that what we are going to do with the fixed cost in marginal, as I said, it will be treated in other non-production costs. Okay, and it will be subtracted from the sale revenue to calculate the profit. Okay, so far so good. So now we have two costing system, marginal and absorption costing. In marginal costing, we calculate the cost of a product. We do not include fixed production overheads. Variable are included, but fixed are not included. In absorption costing, fixed overheads are also included in the manufacturing cost of the business. Okay. Any questions so far? If you guys have any question, please tell me. We good? Okay. All right. Now, thank you, Fahima. That's good for your response. I need appreciation and being alive. Thank you. Okay. Okay. I'm trying to work out the example that I'm trying to put in. Now, in absorption, we include the fixed cost. In marginal, we do not include. If you see, the rest of everything is the same. This one, this one, this one, this one. Yeah. Okay. The difference is here. It's not included here. Okay. And this will make the cost per unit different. Okay. Now we have studied that in absorption costing, fixed overheads are going to be included in the cost per unit of a product, right? How do we do that? Because fixed cost is fixed and it is in total, like rent and electricity. So how do we make it per unit? Okay. Now absorption costing process. What will be the process of absorbing or added overhead or adding overhead? So now we are going to study. Leave marginal costing. We leave marginal costing for a while and we focus on the absorption costing process of adding overheads to the process. Now, The prime cost and variable overhead doesn't need anything, all right? It's already per unit. So the process mainly relates to the fixed overheads. Absorption costing process of absorbing fixed overheads. Fixed production overheads in product costs. Also called the cost of goods sold. Okay. What do we do? You will be given budgeted fixed overheads. This is again way below the level of F5. So I'm going to very specifically tell you what to do. So focus on the process mainly. Okay. You will be given budgeted fixed overheads for a particular planned level of activity. Okay. So for example, you are told that the company wants to produce budgeted production is say 10,000 units. Okay. And for the 10,000 units, the budgeted fixed overheads, the planned expectation is say $50,000. This is a budget. Can you please give me 1 minute? I'm just turning off the AC. It's getting too much colder and my hands are shivering. So. Okay. By the way, it's around 44 degrees here. What's the temperature at your place? I think it's quite mild in Mauritius, isn't it? What's the current temperature there? It's an odd question to ask, but sometimes getting into gossip is good. What do you think? Are people hearing me? Okay, I guess you don't you don't want to share it. Anyway, okay. So we were focusing on the absorption process. Okay, how to add overheads. Oh, 23. You people are in heaven. Okay, it's literally 44 degrees here and you can't even go outside. Along with that, we have a 20, so Port Louis for 26. Okay, all right. Anyway, so we were learning how we add fixed overhead and absorption. How do we do that? Okay, so you will be given a budgeted activity, planned level of activity. Budget means a planned level of activity. This is what we want for the next session, not for the current. This is what we want to do for the next period. And you will be given a fixed overheads for that particular planned level of activity that, okay, we want to do this much production. For this production, we expect this much fixed overheads to be incurred, which is here fixed 50,000. Okay. Now, after the period end, you will be given actual results. Okay, and actual result says that actual production is, say, simply 8,000 units. How much will be the fixed overheads? Now, the process is very, very simple in 2 steps. Number 1, you have to relate the budgeted overheads with the budgeted level of activity, divided to calculate a fixed overhead absorption or recovery rate. Okay, not on the actual, divide the budgeted fixed overheads over the budgeted activity. In this case, let me write to you. Budgeted fixed overheads divided by budgeted activity. In this case, budgeted fixed overheads are 50,000 and budgeted activity is 10,000 units. So we have a $5 per unit fixed overhead. That is this is called an overhead absorption rate. In short, it's called an OAR. It's also called an overhead recovery rate, or simply you can call it a fixed overhead. I call it a fixed overhead expense rate. This means that the company expects $5 of fixed overheads to incur per unit. How much actual units are made? Now, this rate is a budget rate. This is not an actual rate. Okay, because it's calculated from the budget. Step number 2. This is the two-step absorption process. The beauty of this is it's always like this, A plus B whole square. Okay, budgeted overheads divided by budgeted activity rate, and then the second, so first is calculation of the rate. Number 2, absorb. And how do we absorb? For the absorption process, simply what we do is take actual activity, it's a formula. Take actual activity and multiply with the overhead rate. So if we have 50,000 overheads for 10,000 units, how much overheads will we expect to incur for 8,000 units? It's simply if 50 is for 10 per unit 5, then for 8,000 it will be 8 times 5, so it means $4,000 overhead. So in the production cost, we will be adding how much? We will be adding $4,000 of fixed overheads. Okay, we'll be adding $4,000 in fixed overheads. And the production cost. In marginal, we are not going to be adding this cost. Okay. So let me repeat. We'll be given a planned level of activity. We will be given a budgeted fixed overheads. We calculate the rate that, okay, per unit, we have this much overheads to be incurred. How much is it for 8,000? And it doesn't matter if it's 8, if it's 7, if it's 6, if it's 5, just multiply the $5 for that with that, and you will get overheads for that level of activity. Oh, it should be 40,000, sorry. Exactly. Thank you. That is encouraging. It means you are listening carefully. Okay. So if it was instead of 8,000, if it was 7,000, doesn't matter. 7,000 times 5, 35,000. If it was 6,000 units times 5, 30,000. That's it. It doesn't matter. It's really simple. It's not rocket science. Simply planned level of activity, budgeted fixed overheads divided by the planned budgeted activity, multiply with actual. There you go. There is your fixed overhead that will be added to the production cost of production. Okay. In marginal, it will be included in other costs. All right. This planned level of activity can be anything other than the volume. Here, I'm talking about, I am talking about this units. Yes. Here, we're given units. It can be any other measure because it's just a measurement basis. It can be like any other measurement basis like labor hour or machine hour. For example, absorption. Now, whenever I use the word absorption, it means adding overheads or calculating the cost of a product based on absorption costing, where we add fixed overhead. Absorption based on labor hours, labor or machine hours. Or calculation of overheads. So again, the same thing. You will be given a budgeted fixed overheads figure. Say budgeted fixed overheads are $32,000. And you are told in the question, you will be told that absorb fixed overheads based on labor hours. Means estimated on the basis of labor hours. You will be given budgeted labor hours then, obviously. Budgeted labor hours. And say that is 8,000. Now this phenomena means what? This phenomena means that a company is incurring, oh sorry, not incurring, expects to incur $32,000 over 8,000 working of labor hours. So they are planning to work 8,000. It's budgeted, it's not actual, right? So they are planning to work 8,000 labor hours, right? They are planning to work that much hours, and on that labor hours, they're expecting to incur 32,000 cost, fixed overhead cost. Okay. Okay. Actual results. Actual production will be given as well, but you are not needing production. Why? Because the rate is based on labor hours, so you will need a labor hours rate and a labor hours to calculate it, to estimate the overheads. Actual labor hours worked, let's say 5,000. Okay. Estimate the overheads for 5,000 hours. Very simple. Step number 1. What did I tell you? Budgeted fixed overheads. Okay. Divided by, now I want to estimate it based on the labor hours. So divided by budgeted labor hours. Now, budgeted fixed overheads are 32,000 divided by budgeted labor hours are how much? 8,000. Now, again, let me repeat to you. This means that the company is planning to work 8,000 labor hours, and over that 8,000 labor hours, they are expecting to incur 32,000 costs. So it means they're expecting to incur what? $4 of overheads for each labor hour. Is it right? Good. It means they are expecting to incur $4 over one labor hour. So one labor hour works, right? The interpretation of this is mean one labor hour works incurs $4 of overheads. It's not related to wages, right? We're just measuring it. Okay. So if one labor hour works, then electricity, rental, all the expenses are $4 per one labor hour. How much the labor has actually worked? Labor working is 5,000. Now, the formula is what? The formula is actual activity. Now, the actual activity in this case is labor hours, because we are estimating based on labor hours. Whatever is the activity basis, we use the same activity to calculate as well. So the actual activity here is the labor hours multiplied by the fixed overheads per labor hour. for the overhead absorption rate per laborer. So the actual activity is how much? 5,000. We already did that. 5,000 hours worked. And each hour will incur $4. So the expense will be what? $20,000 will be the fixed overheads absorbed or added. Absorbed means added to the product cost. Is that right? And if it was machine hours, you simply replace this 8,000 with whatever machine hours were given. Did you get the process? Okay, we're going to do a question on it because we have done all, we need to have an overall question on it, how the whole thing works. It's just a process of the fixed overhead. We need to do the whole question on it. Are we good with it? Before moving on, I need to get this relaxation from you guys that we are good. As I said in the start, because it's in F5, they're trying to include it and not include it. So it's not really, I still gave you a lot of things which are not there in the book because they are really needed. So I don't know in F5 what they want to do with the absorption and marginal costing. They have just introduced it and then they have taken it to the extreme without giving the middle explanation. The one that I'm doing for you is from my own right now, just to give you an overall theme of what is actually happening. Okay. All right, Sonam, Fahima, and what about the other two? Nishika? Hoshal or Khushal? Hoshal. Okay. Good for you. That's great. Okay. Apologies again for mispronouncing. Okay. Right. So let's do a question. Maybe you get more good with that. Okay. Let's do a question. Okay. Let me write to you a question from my self, which I have already decided, right? Business has budgeted production. Price per unit is $30. These are direct costs, right? Material cost is $5, labor cost is $4. We have variable production overhead, which is say 3. Okay. Budgeted fixed overhead are say $16,000 and are absorbed on the basis of budgeted labor hours, which are $4,000. Oh, sorry. Take 4,000 hours. These are budgeted. Actual results are as follows. And actually what happened is they produced 1,500, right? Actual production and sales. (1,500 units). They planned to sell 2,000, but they actually sold 1,500, right? Actual labor hours worked, which is 3,000. All right. Calculate the profit, total cost, cost per unit, and profit. Three things under absorption costing, right? And marginal costing. So this is what we're going to do. Okay, so this is our whole situation. Okay, we have a question example: budgeted production and sales 2,000. We have sale price, material cost $5, labor cost is 4, variable production overhead is 3, budgeted fixed overheads are 16,000 and are absorbed on the basis of labor hours. I have given you what to do with it. Actual results are production and sales 15,000 and actual labor hours are 3,000. We're going to calculate total cost, cost per unit profit under absorption and marginal costing. How do we do it? Let's start doing it. Okay, do it using the absorption cost. In fact, I'm going to do it side by side. So this is absorption. And all right, in absorption, right, how do we calculate the profit? We calculate the profit by subtracting all the production costs from the sales revenue. Okay, so let me give you a taste of how the cost of sales and other expenses are treated in an internal costing system profit statement, right? So we are actually making a profit statement right now. So what we do is, I'm giving it a bit, this bit more time, settle down and see how profits are made, where which item is treated, because this is important for your basic understanding. Okay, so we have sales revenue, and from the sales revenue we subtract the cost of manufacturing or the cost of production, which is also called the cost of goods sold. Cost of goods sold, which is the cost of production. Okay, and that includes what? That includes material cost, labor, variable production overheads, and fixed production overheads. As I said, that in the absorption costing, the fixed overheads will also be part of the cost of sales or production cost. The cost of sales is called the production cost. Okay, so we calculate the total cost And whatever is the total cost, we subtract it from the sales revenue to calculate the gross profit. Okay. In marginal costing, let me give both of them side by side. In marginal costing, you take the sales revenue, the same sales revenue. We subtract from it the production cost, which is the cost of sales, cost of goods sold, COGS, or production cost, which include what? Which include material cost, labor, okay? It include variable production overheads cost, but it will not, the production cost will not include the fixed overhead. So where it will be included? It will be included below the gross profit, which is the other expenses. Okay. Okay. From the gross profit, we subtract other expenses. Other means non-production expenses to arrive at what? To arrive at net profit. Okay. And so is here as well. Right. In marginal costing, the gross profit is called a specific name. It's called contribution. Why? It has a purpose, but simply just to differentiate between the marginal and the absorption gross profit. It's called contribution. It's the same gross profit, just called contribution. And from the contribution, we minus other fixed expenses. And we calculate the profit, which is the net profit. So let's calculate this question and see how everything is treated, okay? Along with fixed overhead and how cost per unit is made and total cost and profit, okay? The budget is 2,000, okay? The budget is 2,000. 2,000 units were planned. Actual production and sales are what? 1,500. So the profit will be based on actual production and sales. This thing keeps popping up by itself. I don't know what the problem with this. Oh, anyway, so the actual production and sales is 1,500. The profit will be based on what actually is sold and not what they were planning. They were planning 2,000, but they actually did 1,500. So the sales revenue should be based on what? The sales revenue should be based on 1,500 units which is sold. Okay. So the workings will be 1,500 multiplied by 30. The workings are slightly smaller, but please bear with me. So I think this is 45,000. Okay. Because 1,500 units are sold at the rate of $30. Okay. Cost of sales, material cost. 1,500 units are produced. So 1,500 and material cost is how much? Material cost is, this is the sale price. Material cost is 5, labor is 4, and variable overhead is 3, and all of them are per unit. Okay. So 5, 4, and 3. So material cost is 1,500 times 5, labor cost is 1,500 times 4, and variable overheads is 1,500 times 3. So the cost will be 7,500 for material, right? 6,000 for labor and 4,500 for the variable overhead. Now, we already have established that in absorption costing, fixed production overhead should be part of the production cost. This is the production cost. This is the non-production area of the cost. So we include the fixed production overhead in the production cost. Okay, so it becomes part of the manufacturing cost. Okay. And how do we do that? Remember the process? Just gave you the process a while ago. And in the question, we have been told what? In the question, we have been told that budgeted fixed overheads are 16,000 and are absorbed on the basis of labor hours, which is 4,000. Budgeted labor hours. Okay. So for our absorption process, we need what? 2 steps, right? Budgeted fixed overheads divided by budgeted labor hours. Okay, because this is where we get the rate. Step number 2, absorption. Absorb means add overheads. How do we do it? The formula is actual activity. In this case, it will be actual labor hours multiplied by actual labor hours multiplied by the fixed overheads rate per labor hour. Rate per labor hour, because we have been told that absorb or estimate the overhead based on the labor hours. So in the question, we are given that overheads are 16,000. See that? Budgeted fixed overheads are 16,000 and budgeted labor hours are 4,000. So 16,000 fixed overheads are expected to be incurred on 4,000 labor hours of planned working. Right? If 4,000 labor hours works planned, right, 16,000 cost will be expected to be incurred. So the cost per labor hour is what? $4 per labor hour. This is what? This is the overhead absorption rate, on the basis of which we are establishing or calculating the overheads. So each labor hour has $4 of expense. Actual labor hours, then how do we absorb? We did it 2 times before. Actual labor hours, as we did it in multiple cases, actual labor hours are how much? 3,000. Now 1,500 are the units given, all right? We are not estimating it on the basis of units, we are estimating it on the basis of hours. Whatever measurement basis is used to calculate the rate, which is here the labor hours, the same basis actually will be used to calculate the absorbed overheads. So if we are calculating the rate based on labor hours, we multiply it with the actual labor hours. If we are calculating the rate based on production, budgeted production volume, we multiply it with the actual production volume. If we are calculating the rate based on budgeted machine hours, we are actually multiplying with the actual machine hours to calculate the estimated or absorbed overheads. So actual labor hours in the question are given, and that is how much? That's 3,000 labor hours. And the rate is $4 per labor hour. So how much overheads will be added? $12,000 of overhead will be, these are what? These are absorbed overheads. Okay. This is what? This is going to be fixed overhead absorbed. And how much is it? It's 12,000 from the one. Okay. So what is the total cost? Now add all of it. You people also do it so that if I do any mistake, which is possible, so it is corrected. So with me, this is 30,000, the total cost including. This 30,000 is what? This 30,000, it becomes what? This 30,000 is the production cost now. Okay, so 45 minus 30, the gross profit, 45,000 is the sales, minus the 30,000 is the cost of the goods. So this is the gross profit is 15. Why it is called the gross? Because from this 45,000 sale revenue, we are only subtracting the manufacturing cost. There are other non-production costs as well, like sales, admin, carriage cost, IT, R&D, and all of those has to be subtracted as well, which I'm not listing here because we're not really learning financial accounting. So they are also deducted, and we get what? We get our net profit in this case, which is 15,000. Okay. And there is a slight problem that we have to address here. So I'm not going there right now. But in marginal, what do we do in marginal costing? All right. Before moving on to marginal, tell me, are we good with this calculation? The total production cost of 1,500 units is 30,000. Let me write the takeaways from this. This is the, you can say the ultimate learnings from this. Total production cost, 33,000. Cost per unit. Cost per unit is simply the total production cost divided by the number of units produced. Total production cost is how much? For how much units? 33,000 was the total cost. How much units? 1,500 units. So how much is the cost per unit, which is 33,000 divided by, this is $22. So it means each product costs $22 to make. Okay, and the profit you already. Okay. Will marginal cost per unit cost be the same? What did we learn? No, it's not going to be the same. It's going to be less than this. Let's see how. Okay. Now we calculate the cost and the marginal, the total profit under marginal costing. So the sale revenue is going to be the same, 1,500 multiplied by 30, which is 45,000. Okay. Production cost will consist of only 3 costs. All right. There will be no fixed overhead. See that is empty. That's the difference. Okay. So material cost is how much? We already calculated the material cost. Material cost will be 7,500, which is 1,500 multiplied by 5. The other one is 1,500 multiplied by 4, which is 6,000. Third one is 1,500 multiplied by 3, which is 4,500. That's it. There will be no fixed overheads included in the manufacturing cost. Okay. So 7,500 plus 6,000 plus 4,500. This is 18,000. So the total production cost is 18,000. From 45,000, we subtract 18,000. Sales revenue minus the production cost. So the gross profit, which is in marginal costing called the contribution, will be 27. From the 27, we subtract other fixed costs, which is other costs, selling, distribution, marketing, which is the same here. And this other cost, in this other cost, we will also subtract fixed production overheads, which is the difference. Now, if you see here, we are including fixed overheads in the production cost, while here in marginal, we are including it below the gross profit in other costs. That is the main difference, right? That will not create a difference in the profit, but that will create a difference in the production cost. It means that the production cost of marginal costing will be less because it doesn't include one major item. So in marginal costing, the total production cost is what? In marginal costing, the total production cost is 18,000. If I'm not wrong. Yeah, 18,000. So the cost per unit will be what? The cost per unit will be the total production cost, same, which is 18,000 divided by the number of units, which is 1,500. That is $12. Okay. So the cost per unit, and see the difference? It's 22 and it's 12. It should not be 12. I think we made a mistake somewhere. Somewhere there is a mistake. I don't know where. Oh, okay, I got it. Did you guys notice it? No, I got it. Ah, yes, Nishika, that's great. That's great. Yeah. Thank you. And that is encouraging again. It means you people are focusing. Thank you. This is 30,000. What I did is I took here 33. I don't know why. Maybe I'm hungry because it's 2, 3 o'clock. Okay. All right. So it's not 20. This one, that one is correct. That one, the 12 one is right. The 12 one is, this is okay. This one is not 22. This is actually. So the difference of fixed overheads is what? Is $8. That's what the difference between the two. The absorption per unit cost is higher than marginal per unit cost, and it always will be. Why? Because in absorption, we are including a cost in the total production cost, which is not there in marginal. So there will always be this cost per unit difference. Okay. Okay. Now we're going to complete it to the net profit, but for that we need to add just another thing. So there is one last thing that I want that we need to introduce. Okay, so there is one last thing. Now, before moving on to that, are we fine till now? Everybody's fine till now? Any question, please just ask. Clear? Okay. All right. You guys have to give me around 2-3 minutes. Just going for a water break, right? Throat is really thirsty. If you want to take a water break, just 5 minutes, right? So I'm gonna be back in 5 minutes, right?
All right, everyone, I'm back. Is everybody here? Right, apologies for the sorry. All right, I was actually taking another class as well, and there are some issues with jobs as well, so people are calling from there as well, so I have to attend that. Anyway, so far, are we good with the working that we have done so far till now? Anything bothering you? Anything that you want to ask, please do not hesitate. Okay, what we're going to do, we are going to make a WhatsApp group as well. And in that group, I'll be available to you guys for the next 4 months, 24/7, right? Only when I'm sleeping, you can post the questions. And when I wake up, I'm going to answer, but I will be there for you all the time. So that's something that can be valuable for you, because students definitely need help from their teachers all the time, and not just the class, because the class is going to be once in a week. So what I'm trying to tell you is that you don't need to wait for the whole week to answer to question and to ask a question and to ask something that is bothering you, because if something, sometimes it happens that something is bothering you and you cannot go ahead because that is where you start. So it will be a very, it's going to be a loss if you get stuck and you then wait for the whole 7 days, 6 days to pass and then ask me a question, and the whole week study is wasted. So you can post questions there. These notes will be given to you as well. As soon as I finish the class, I'm going to tell my institute and the admin people to make the group and give you the lecture notes. Okay, now last thing that I'm going to introduce, a slight technicality, is in this question. All right, that technicality is when we absorb overheads, on the basis of actual activity, right? The concept that I explained. What I explained is that we have budgeted fixed overheads divided by budgeted activity to calculate a fixed overhead rate. That is step 1. Okay. And then what we do is we multiply the rate with actual activity, multiply with the fixed overhead rate to calculate absorb overheads, which we then charge to the cost of product. All right. Now, what these absorb overheads are, all right, I want everybody to focus. Okay, everybody to focus. Okay. What these absorbed overheads are, these are not actual overheads incurred. Okay, why? Because we are multiplying the actual activity with a rate which is a budgeted rate. Okay, so these absorbed overheads is not the actual overheads incurred, this is the estimated overheads for that particular actual activity. Let me repeat what we calculated previously when I started this topic. That there is $50,000 overheads over 10,000 units. So the rate per unit is $5. The fixed overhead expense rate is $5 per unit, right? Okay. Then I said that actually, instead of 10,000, 8,000 units are made. Actual production or units are 8,000. Then what could be the overheads for 8,000? For 10,000, if it is 50, what it will be for 8? And it's simple. If it's 50 for 10, for 8, it's going to be 40. Now, use your common sense. If you're multiplying 8,000 with $5, which is a budgeted rate, then is that 40,000 actually incurred or paid? The answer is no. If it's not actually incurred, what's the need of estimating it for the actual activity? Now, the reason is, whenever we are calculating profit, the reason for this is normal. It's a normal daily life thing. It's not something related to absorption or something. When we are calculating, the profit, we are subtracting the sales revenue. Sorry, we are subtracting the cost of sales or production cost from the sales revenue, right? Now, we are calculating the production cost from the sales revenue, and these production costs are actual costs. Okay. Now, in absorption, the cost of sales include material, labor, variable production overheads, and fixed production overheads, right? Now, this material is actual cost, labor is actual, whatever is incurred for 1500. Here it's 1500. This is actual, this is actual, this is actual. Fixed overhead is not actual. This is not based on the actual cost incurred. Why? These fixed overheads mostly include what? Utility bills, electricity, gas, heating, lighting, and often these utility bills, they are actually calculated and reach in arrears. Arrear means later on. So the January bill often is delivered to customers in February. Okay, what I'm trying to tell you that what actual fixed overheads are for the month of January, say if it's the month of January, the actual fixed overheads for the month of January will be known only when it's February, while we are calculating the profit in January. Okay, so we can subtract actual fixed overheads, but for that we have to wait till February. We can subtract actual overheads, but we have to wait till February to clear all the bills, the gas, the charges, everything, so that everything is cleared. Actual bills are collected, utility bills, and actual all the authorities, sends the customers their related bills, and then in February we will know what the expense in January is. So, but then what will happen is we'll have to wait for January profit to calculate. We'll have to wait till February to clear all those expenses. Only then we can subtract actual fixed overheads. But can we do that? Should we? Or we can do that, but should we do that? Should we be waiting for fixed overheads to clear so that actual fixed overheads appear or collected, and then we subtract and calculate the profit of January in February? That's not why profit is kept. We need to calculate the profit of January at the end of January in order to know what's happening in the business. What will be the point of calculating January's profit in February? Okay, so we have everything actual. We have sales actual in January. We have material cost actual, labor cost actual, variable overhead actual. Fixed overheads are not actually yet collected. All right, they are not yet known. So what do? There are two ways. Number one, wait till February so that actual fixed overheads are known, and then charge that. But then, as I said, that January's profit will be calculated in February.
right? The second is, what we do is we make an estimate for January's fixed overheads, which we do. Okay. Okay, it's January's month. 8,000 units are made. The expected rate is $5. 8,000 units are actually made. At $5, actual expense will be, sorry, absorbed overheads or estimated will be 40,000. So this 40,000 that we are subtracting here, where did it go? Here. This 40,000 that we are absorbing and subtracting is not the actual. This is an estimate for 8,000 units. That if 8,000 units are made, which is actually made, expense could be 40,000 based on $5 rate. Did you guys get this phenomena? Did you guys get this? This 12,000 here charged in this example is an estimate for what? This is an estimate for the 3,000 labor hours. It's not the actual expense. Yes, Fahima, you can leave. Later on, you can watch the lecture. All right, you can watch the video lecture later on. Yeah, no issue. You're allowed. Okay, let me repeat this just for a minute. Let me repeat this just for a minute. Okay, we're calculating the January's profit. Okay, we're calculating profit for January. Profit is what? Profit is actual sales revenue, and profit is calculated at the end of January, right? So we're calculating the profit of January at the end of January, which is the sales revenue minus all the cost incurred. And the cost in absorption are what? Material, labor, variable overhead, and fixed overheads. The problem is we have actual sale revenue, we have material cost, labor cost, variable. We don't have this. This will be known later on. So we either wait when it incurs and clears, then we calculate, then it's going to be too late to know the profit. Or the second thing is we put an estimated figure. Did you get it now? So the absorbed overhead is an estimated figure, because the actual fixed overheads are known after a month or so, and we cannot wait that much to calculate the profit for the previous month, right? So what do? We estimate, okay? So this 12,000 here is an estimated fixed overheads for the 3,000 labor hours worked. Now, it means what? It means that this estimate can go wrong as well. Later on, it is possible that actual fixed overheads may be a bit higher or lower than what we have estimated. Okay, so let's come back to the example now. Did you guys get the phenomena of this issue that we are trying to calculate the profit? For a profit, we need actual cost. The fixed overheads is not actual. Why? Because fixed overheads mostly includes utilities which are known very late, right? So what we do is we cannot wait, so we put an estimate. Later on, actual fixed overheads are incurred. So how much we estimated? Now, the absorbed overheads are 12,000. This is what we absorbed. Absorbed means included in the production. Later on, say, for example, fixed overheads incurred after a month were cleared, that fixed overhead incurred for January was 15,000. Okay. Now, how much we added to the production? We added to the production 12,000. It means in this 30,000, 12,000 is the fixed overhead, which is subtracted from sales. So the expense of fixed overhead subtracted from the sales is 12, while actual expense incurred was how much? 15. The estimate which we put there and which was actually subtracted, which is the absorbed overheads, was 12. Okay, so we have subtracted 12, while actual expense incurred was 15. Okay, this is exactly like you gave someone 12,000 to buy something for you. Okay, you wanted something, to buy, and you ask your friend, and you ask your friend to buy you that item, and he told you, okay, give me an estimated amount, and you told him, okay, this is 12,000, and I expect that within this 12 it will fetch around this 12,000. Okay, we gave him 12,000. That's it. When he bought it, he told you that you gave me 12,000, but because of inflation and things, now it's 15. So actually, I bought it on 15. And you have already given him, based on your estimate, you've given him 12. So what are you going to do now? You're going to give him 3 more, right? Until and unless you're trying to tell him that this is your gift for me. Okay. So what happens is we call this phenomena under or over absorbed overheads. Okay. Call it under or over absorbed overheads. Right? When overheads are either underestimated or overestimated. Under or over absorbed means underestimated or overestimated. Right? And this is done only in absorption. Not in marginal, because in marginal, we are not estimating anything, right? In marginal, the fixed overheads are not even included here. So there is no point of any estimations. We are only doing this in absorption. Okay. So under and over estimated overheads. And this is when we compare two things. What we have added or absorbed in the production. Okay. We absorbed. Now, in the above question, how much we estimated that fixed overhead will incur? 12,000 based on the actual activity multiplied by the rate. Okay. While actual fixed overheads incurred is say 15,000. Let me write it in the question. Where is the question? Here. Say actual fixed overheads incurred. Okay, so now you can ask me a question that, sir, we already know this, so why don't we charge 15 instead of 12? Now, you will be given this figure in the question, but it is assumed that this will not be known when we are estimating this cost. When we are calculating this profit, this will not be known at that time. If it was known, then we would charge it simply 15,000. We would charge the actual, means we would charge the actual. We don't need to estimate. So now we estimated 12,000 based on Based on what? Based on the budgeted activity and budgeted overheads multiply with actual. Based on this, 16,000 divided by 4, $4 is the rate. Actual activity is 3. Based on $4 rate, fixed overheads estimated, absorbed means estimated, can be 12,000. We added this to the production cost. Later on, actual fixed overheads incurred, and they are 15,000. So now what we are going to do? What we are going to do is absorbed is 12 while actual is 15. We call this phenomena under absorbed. Under absorbed overhead. Under absorbed means simply underestimate. We made an estimate of 12 while actually fixed overheads are 15. So it means that $3,000 expense is now incurred extra. So what do we do with it? We subtract it. This is the treatment. We subtract it. In absorption, we subtract from the gross profit because this is a further expense. All right. We subtract from the gross profit. So here from the gross profit, we calculate absorbed overheads, which is 12. Actual overheads incurred, this is 15, right? When actual is higher, under absorbed occurs when actual fixed overheads are greater than the absorbed, which is estimated overheads, right? Then we have under absorbed. And this is 3,000. We have under absorbed 3,000, and we subtract it. So profit will be what? 15 minus 3 is what? 12,000. In marginal costing, we subtract the fixed overheads and we subtract the actual fixed overheads. There is no point of estimation because we already have the gross profit calculated. So we don't need to wait for anything. So we already have the gross profit calculated, or which is the contribution. Okay. So we don't need to wait for the fixed overheads to calculate the gross profit. Why we don't need wait? We don't need to wait for fixed overheads to calculate the gross profit because fixed overheads are not even included in the cost of sales. So we don't need to wait for fixed overheads to calculate the gross profit, right? Yes, for net profit, we have to know the fixed overheads. So actual fixed overheads, which is 15. So in both cases, the profit will be 12,000. Okay. Why the profit is equal? Here we have estimated 12,000. And then we came to know that we have subtracted 12, but actual expense is 15. So we subtracted 3 more. So actual expenses of overheads, actual fixed overhead expenses, how much? 12 is subtracted before as an estimate, and 3 is then subtracted in more under overhead absorbed adjustment. All right. So total expense is subtracted how much? 12 is subtracted. 12 fixed overhead is subtracted before, 3,000 of fixed overhead subtracted later on because it is we underestimated it. So in total, 15,000 of fixed overheads are actually subtracted. While here we are also subtracting 15,000. So the overall profit is going to remain the same, although the cost per unit will not be the same. All right. If fixed overhead absorbed means what we added in the production cost is 12,000, while actual fixed overheads instead of 15, it was 10. Later we came to know that we estimated 12,000 but actual is 10. This is again the same thing, that you give someone 12,000 to buy something for you, but he actually bought it on 10. So what now? You're not going to give him anything. He's going to give you back. Okay. So this is a phenomenon called overestimation or over absorption. Okay. Just do that. When absorbed overheads are greater than actual, when actual is less. And how do we treat it? We add to profit. Why? Because our estimate was higher. The actual expense is lesser. So then what would we do? We would then add, if we subtracted 12 here and actual expense was 10, then we would add 2,000 here. And in marginal, we would subtract 10,000. Okay. Now, this is a full question on absorption and marginal costing of how to add overheads, budgeted overheads divided by budgeted activity. Let me repeat that. We have two product costing methods. One is absorption, one is marginal. In absorption, the cost of production includes material, labor, variable overheads, the prime cost plus variable overhead plus the fixed overhead. While in marginal costing, there will be all cost, but there will be fixed overhead cost added. How do we add the fixed overheads in absorption costing? It's a process which I told you and explained to you before the question. You will be given a planned level of activity. It can be units, it can be labor hours, it can be machine hours, and you will be given a planned or budgeted overheads for that. Okay. So 10,000 units are the planned activity. 50,000 is here in this example, budgeted overheads. We'll calculate a rate, which is $5 per unit. Okay. Actual activity will be taken and we'll multiply the rate with it, which is here $5. So actual activity, if 8,000 and if overheads expense rate is expected to be 5, then 40,000 overheads will be absorbed. Now these overheads are not actual; these are the estimate for the actual activity. Why we need to estimate it? Why don't we charge actual? As I said, that actual fixed overheads include mostly the utility bills, and they actually are collected and they are sent to customers very late. Customers means by the authorities, right? So the business will receive their utility bills 1 month after. So one thing we can do is to calculate the profit, which is the sales revenue minus all the actual cost. One thing is to calculate the profit for January or February, any particular month, is actually